James, the Lowland portfolio has quite a long list of holdings. Why are there so many?
It's a mixture of large, medium and small companies, and that means we need a long list. Particularly among the smaller companies, we're often buying companies that have really got good recovery potential. We don't know when they're going to recover. Some holdings are at 0.5%, but I had one holding at 0.5%. The losses, for instance, put it in at 0.5%. It's now 2.5% of the fund. It has gone up 5 times in the last 2 years. Therefore, a small holding, 0.5%, is still worthwhile to the overall return. It was a high risk position when we took it, but it has proven its worth. Therefore, we need a long list to buy these higher risk companies. We have about 110 stocks in the portfolio, and 60 of them would be smaller companies. That smaller companies part of the portfolio accounts for about a third of it. So it's because we're running smaller companies, higher risk smaller companies in some cases, often the forgotten smaller company that we believe has been wrongly forgotten. And that type of approach needs a long list of companies.
At the moment, UK company valuations seem relatively high compared to history. Where are you finding attractive valuations at the moment?
I don't believe valuations are high. Companies are generating a lot of cash, and it is cash that I follow. If companies are making profits, and those profits are cash profits, they can be very attractive. These cash profits are coming out in big dividend payments. We're seeing special dividends paid out to shareholders. For instance, Hiscox has paid a special this year, a large special dividend. Elementis, a specialty chemicals company, has paid a large special dividend this year. It's this cash generation that's coming to shareholders in the form of dividend payments that I think it makes equities attractive. I don't believe valuations to be too demanding. If you've got this kind of cash generation, I can see valuations going a lot higher.
If we look at the portfolio, it's underweight large capitalisation companies. Is this likely to continue?
Yes, I believe the best opportunities lie in medium and smaller companies. It is the small company that goes all the way up through being a mid-sized company to a large company that really adds the value. We've had one or two over the years like that. I would point to Weir Group, which was a small cap when it was in the portfolio initially, is now in the FTSE 100. Croda was a mid-sized company, is now in the FTSE 100. It is companies like that that really add the value. It's important not to sell them too early. And both those companies I reduced at times because they were too large a part of the portfolio. I regret some of those reductions. I'm allowing the successful smaller company that's growing into a medium-sized company to be a larger part of the portfolio. But there have to be some disciplines. You have to take profits sometime and recycle. So at 3%, I'm recycling the money out of the smaller company, but I'm keeping them at 3%.
Now you have Shell in the portfolio, which is Europe's largest oil company. What's the story behind this?
I believe that the portfolio should be a blend of large, medium and small companies. And in some of the large companies, there is recovery going on, that they're changing, there are opportunities. Shell has got a high dividend yield and it will grow its dividend over time. There are some wonderful assets in Shell. It's making some good discoveries. For a long time, Shell wasn't making many discoveries. That's changed over the last 6 months. They've been announcing some good finds. So I believe that within Shell, it's looked at itself. It is back on an improving path.
Finally, James, gearing, which is the portfolio's borrowings, it currently sits at around 12% of NAV. Is this likely to change?
We'll remain with a reasonable level of borrowings. We're borrowing at the moment at around 1.4%. That's the interest we're paying on that borrowing, at 1.4%. The stocks we're buying are yielding 3.5%, that sort of range. So immediately when we're buying a stock, it's more than covering the cost of borrowing. On top of that, we obviously hope those stocks will appreciate over time. And I believe that from the current levels, they will appreciate over time.
James Henderson, thank you.